Our second commentary is by Richard Sloan. He's the Victor L. Bernard PricewaterhouseCoopers Collegiate Professor of Accounting and the Director of the Tozzi Electronic Finance Center at the University of Michigan's Ross School of Business.
I'd just like to start again by thanking Peter for setting this up and giving me the opportunity to say a few words in the old group here. And I'd also like to point out that I'm really hoping this doesn't come to be known as the Sloan's an Idiot commentary after the comments we had earlier. I thought I'd just start off with a brief career history, and hopefully you'll see why it's relevant in a second. When I was a young lad, I started off with the sort of ambition of becoming a finance guy, sort of studying investments and security valuation. So I enrolled in a business undergrad degree and took a finance major and took my first investment course with Philip Brown in Australia, who was one of the best professors over there. I was pretty excited, and I remember in session 6 we were going to do asset pricing theory and the CAPM and the APT, and I didn't know what they were at that time, but I was pretty excited because that's where I thought I'd learn about how to value securities. And after we'd had session 6, I realized I'd sort of made a career error, and my only fallback plan at that point was to become an accountant. Being the other sort of major that was closely related to finance. I just thought I'd start with a slide here. I'm just going to give some very, very general perspectives here because I think Duran did a great job at summarizing the literature. I found I was in reasonably good company because here's a quote from Warren Buffett. He gave this at a talk at Columbia several years back, sort of saying, our Graham and Dodd investors, needless to say, do not discuss beta, the capital asset pricing model, or covariance amongst securities. The investors simply focus on two variables, price and value. Now, presumably, the folk who came up with the capital asset pricing model and all that were also interested in learning about value. And so it's sort of curious to think how these two people who are interested in the same thing, or these two groups of people, sort of come at it from two very different angles. And I think the reason is here, if you look at the theory behind the CAPM and APT, and that one of the underlying assumptions is investors all know and agree upon the distribution, the mean and variance of the future cash flows, the future payoffs. So they've assumed away the forecasting problem, and that leaves risk as the thing to worry about, the thing that determines value once you've assumed away the cash flow forecasting problem. But I think where Warren Buffett's coming from is that the forecasting problem is, for practical purposes, the important one, the first order problem that needs to be solved. And good valuations and good financial decisions come from good forecasts. And I guess that's sort of, I think, the way that I was coming from. And so just some general observations here. I'm sort of glad I got to go on this session because I think, and this is just my personal opinion, in finance, the most important practical activity is forecasting the future financial statements, and we use the financials as an instrument to forecast the cash flows and all the other things we need to know to make our business decisions. Starting on Monday, I guess, Alcoa will announce earnings, and that'll start the current earnings announcement season. The Wall Street Journal and all the other financial sites will basically be plastered, will be dominated by earnings announcements going off for about 6 weeks. I'm pretty sure we won't be reading about an unexpected increase in the beta for company XYZ, but we'll have plenty of positive and negative sales and earnings surprises. And so I think in practice, this is where the action is, and this is where we need to focus more attention. Why haven't we focused more attention? Why are we at where we're at? Well, academic researchers have been slow to develop a systematic body of knowledge in this area. Finance academics have gone down this path of EMH, where they sort of assumed away the forecasting problem. They assumed everyone had got that one right, and it was in the risk we needed to finesse it. And accounting academics, well, it really is outside of accounting. We force our Mac students to take our FSA course. We think it's something they should have to be good accountants. And they actually don't like the fact that we require them to take it. It's not on the CPA exam, and they think it just isn't accounting. But I think we've done a great job at coming in and filling the void here, and though we're a little late, we're now doing good work. The other question is, why haven't finance practitioners done more here? I think that one of the key reasons is they're very fragmented and concerned with proprietary information. I've worked with a lot of the quantitative investment managers and other folk out there on Wall Street who do this for a living, and they're always worried about letting me know anything because they're worried I'll go and write a paper on it. They figure if one or two of their competitors learn something, that's not going to be too big of a deal because the information won't be that widely known, but they don't want an academic to get a hold of it because then everyone will know it. And I think there's also very significant agency costs out there in the financial intermediation process. I don't want to be too cynical here, but the sort of students of mine who go into Wall Street and doing this, they're not the sort of students who are interested in helping widows and orphans. They're in there to make money for themselves, and I think Wall Street does a very good job of keeping the barriers to entry high, the information proprietary. If you look at the CFA exam, which is perhaps the CFA body of knowledge, as they call it, which is where we could go and see what practitioners are doing. By and large, it's just a hodgepodge summary of the academic research. There's not a whole lot of their own knowledge that they've developed independent of us. Just a quick summary of what we know, and I'm going to go through this very quickly because Daron's already talked about this. Sell-side analysts, at least as Rick pointed out earlier, their forecasts seem to have stuff in them that we can't get from simple time series forecasts. At the same time, there's systematic biases in sell-side analyst forecasts that we can identify through fundamental analysis. I'm still pretty excited about how powerful, for example, accruals-like signals are at predicting earnings surprises, things in future earnings that analysts don't seem to be able to anticipate. And I think that ultimately, in terms of tying the accruals to the market inefficiency and the inability of analysts to forecast earnings, this is going to turn out to be pretty important evidence. And what this also tells us is the sell side. I mean, we did point out that the sell side analysts are just one group. The buy side don't seem to be able to do a much job. Seem to be doing a much better job than the sell side because these predictable biases in the sell side forecasts don't seem to be reflected in stock prices. So I think there's certainly a lot of opportunity, not for us to discover things for ourselves, but to discover things that practitioners don't yet know about. And just some closing comments about future opportunities and challenges. As I sort of alluded to, I think there's still a lot of low-hanging fruit in this area. I'm working on a topic right now, and I think the idea will be straightforward to everyone, but the results come through real nicely. If you take an inventory write-down, the SEC requires you to put that in cost of goods sold. So we think of it as sort of a non-recurring charge, but it has to go up in the gross margin. With Chad Larson, a PhD student, we collected a whole sample of these inventory write-downs. And as you'd expect, I think this is just a FSA 101, the companies that take these inventory write-downs have big increases in inventory and reductions in inventory turnover ahead of them. Then the write-down comes along and temporarily depresses gross margin, and then the gross margin pops up again a couple of period or two later. Well, it turns out that stock prices and analyst forecasts don't sort of see this coming. They don't interpret or fully interpret the slowdown in inventory turns as a sign that there's increased likelihood of an inventory write-down. And then they don't fully anticipate the pop back in gross margin that's going to come when the inventory write-down pops back up. So that's just something you can't do on CompuStat, but you can do a little bit more deeper contextual analysis, go and gather the data from the footnotes, and you can see how it's useful in forecasting earnings surprises and stock returns. I think this is still an area where it's low-hanging fruit in terms of, I think, interesting stuff you can document. It's not low-hanging fruit in terms of getting publications. That's still a little bit more of an uphill battle. Hopefully that will become easier. I think finance academics will eventually claim this area back. I think the EMH and asset pricing paradigms are winding down. I have a good sort of like some anecdotal evidence here in that I think Bill Schwerd at the JFE sends me pretty much every paper he gets on accruals that's sent there. And they've been going up exponentially over the past year or two. And a lot of these papers are written by finance folk, and they're getting a good grasp of the accruals literature. I recently had a paper written by a couple of finance academics. They've done a very good job with pension accounting and reading the footnotes. I recently saw a presentation with Charles as an up-and-coming professor. I guess there were two of them at Chicago and Yale, who are finance professors who had some very interesting results. They'd collected data from the segment reports of financial statements. So I think we sort of got a little bit of a head start here, a first mover advantage, if you will, but I think the finance folk will catch up quickly. I think we'll always have a niche, though, in terms of the fact that we'll understand the accounting principles and procedures more fully than the accounting folk will, and so we'll always be able to play a role here. And I think, just as one final sort of comment, the current march towards fair value accounting is going to make earnings forecasting much more challenging and is going to make keep us as accountants in business here, performing an important role in understanding all the assumptions that are going into the fair value accounting, the way this stuff unravels, and using that to help others forecast earnings. So I think this is a great area with a lot of promise, and we're pretty well poised to take advantage of it. Thanks very much.